Hello again, everyone. Dean Jones, President and CEO, Realogics, Sotheby's International Realty, with a fan favorite, Matthew Gardner, here at the end of 25 after the Futurecast Forum earlier this year. Matthew, welcome back to Market Perspectives.
You are welcome, Dean. How are you, mate?
It's good, but you tell me, how are we doing? I mean, this has been a wild ride of a year, and what'd you get right 6 months ago, and what's kind of teaching us a lesson right now?
Oh boy, I got it all right, of course. No, I think, yeah, it's pretty much gone the way that I generally had expected.
Okay.
And I said this back earlier on the summer, obviously, that I think that we will see likely more transactions this year than last year. Not a huge amount more, but more. Now we've still got December to go, but yeah, I think I'm going to be accurate there. I said that we will see positive price growth. I think when we get at the end of the day, we're going to find out, yeah, we eked out a very small increase in prices. So, okay. Mortgage rates, yep. They pretty much tracked down to the 6.25% range, which is what I expected for this year. So those are three things that immediately come to mind. That say, okay, I can give myself a pat on the back and say, yeah, I think we got it right.
I mean, it wasn't a booming year. We all thought with the new administration and some of those policies that this might be a lot of doubling down on investment. You know, the big, beautiful bill took a little while to get passed. And I think a lot of investors might have been sitting on their hands until they knew which way the goalposts were going to be planted.
Yeah, very much so. I think the attitude of most investors was caution.
Right.
So, okay, well, I hear what you're saying. Show me. And they wanted to see the proof first before they started writing out those checks. I think what we saw was a certain amount of caution, skepticism on one side, maybe not on the other side of the political environment. But we are just waiting to see if some of the policy that have been adopted, are they going to be positive? Certainly the Fed has done, again, what I expected it to do. Now the question is going to be, what more are they going to do going into 2026?
Right. And obviously we'll get a read on the tariffs and whether that's going to be upheld or, you know, somehow repositioned.
Yeah. I mean, obviously the Supreme Court is looking at it. They're going to make their decision, I believe, tomorrow. It's going to be interesting to see. If I was a betting man, which I'm not, I think they'll say they'll strike it down. And now, you can say that's great, tariffs go away. Actually, that doesn't happen. The government's got abilities and it can take things down different avenues to still keep at least some of those tariffs. But the trouble is with that, striking it down, I think is a positive thing. And certainly in terms of how the government's talking about, quote, affordability. However, what it does to it just, again, creates another level of uncertainty.
Right.
So struck down, okay, but what does this really mean? And quite frankly, when am I going to see it?
Affordability has got to be addressed in 26. And I wonder, because I was just looking at the 4-county data here for all property types. And actually it's up about 60% listings year to date compared with 24. And that's a pretty big volume increase. And it looks like median home prices are about static and sales volumes are really about static as well. So what's going to give in 26 with all that extra inventory, and maybe more buyers will hit the market with these sharper interest rates?
It's funny when you talk about inventory, and that's certainly the big thing, right? Kind of go back to your economics class in high school. Everything is about supply and demand. And that's in essence what sets prices. So when you talk about affordability and say, okay, well, more supply, that should compress prices or at least stop them from jumping too fast and getting too high, that's going to be good for the first-time buyer. But I still think we've really got a bit of a discrepancy, and that is the fact that more inventory, yes, but a lot of homeowners still have pretty heady expectations as to what their home's worth.
Right.
And the smart ones are listening to their brokers saying, no, it's not worth this, it's worth this. And ultimately, if you start seeing some more realistic understanding as to where prices really are, well, that's going to have an impact on sale prices, obviously.
Right.
If asking prices go down, so will sell prices. So I think ultimately, more supply is not necessarily a bad thing. In fact, you'll see the naysayers out there saying, oh, well, you know, November numbers, we flooded the market. Well, okay, you're saying that, but as far as I can see, that if you go back to the period pre-COVID, and I've got data goes back to 1990, it's still the lowest level of inventory we've seen between 1990 and 2019.
Well, we got some pretty well-heeled sellers. Their make me move price
Right.
is, different than maybe where the market's at. So they'll just
Exactly.
pull their listings. It's the end of the year, lots of inventory coming off the market. Another strategy would be to stay up there and maybe do a little price adjustment and get a home sold before the end of the year. I know in our brokerage, we've had a number of surprising sales recently for that very reason. But if you're still saying we have more inventory than we had this time last year, but less than historical standards, then maybe there is some stability in the pricing. And the new construction side of supply doesn't seem to be happening in the kind of leaps and bounds we were hoping to.
But yeah, very much. And certainly in the single family world. I mean, bottom line is we've run out of land. We've ran out of land a long time ago. In fact, in King County, only less than 25% of the land base within the county itself is inside the UGA. So, and statewide, about 3.5% of the entire land base of Washington State is inside any form of urban growth area. So, yeah, we've run out of dirt. But the builders have got the problems that they've always seen. And it's really frustrating them. They know there's a market out there. They know that if they build it, that's going to be great. The trouble is, it's reconciling the demand with what it's going to cost them to build.
Well, the land ain't cheap. House Bill 1110 is the right policy. I know you quipped that it was finally catching up to demand, but now we have builders going, yeah, well, thanks for the zoning, but I can't pencil this because the retail value is less than the aggregated cost structure of that development.
Ultimately, you look at it and look at the four corners, right, of cost structure for a builder: land, labor, materials, regulatory burden.
Well, and the city of Seattle just raised the cost of permits.
Exactly.
That's going the wrong direction.
And well, there you go. But they're saying that the offset to that is you can pull your permit quicker. Well, it couldn't be any slower, quite frankly. So great, thank you. So yes, I think that builders know it, but when land is expensive, labor is still expensive.
Yeah.
A lot of federal policies on immigration are having certain massive impacts there. Materials, tariffs. So because most of the material it takes to build a home in America come from 3 countries: China, Mexico, Canada. So when you're tariffing those things, that makes it expensive. And of course, the regulatory burden, what you pay in fees, is astronomical. And that's what's really frustrating builders for the better part, is that they see there's demand out there. But the problem is they can't build to that demand at a price point which is going to work. So they're not. So it's very, very frustrating for them.
Yeah, so unless you have higher density projects and you get better economies of scale. So let's bridge into the next markets to matter. We're watching Sound Transit 3 lay down a bunch of track. Maybe next year we'll get that east-west connection across I-90 in time for FIFA. Let's hope.
Yeah.
But look at all these little boom burbs that are popping up like green shoots in the Bell-Red Corridor and the Wilburton area of Bellevue. I mean, everywhere that light rail line is landing is being upzoned, and pretty sizable redevelopment opportunities.
And absolutely right. And quite frankly, as far as I'm concerned, the station area overlays, they could have gone more.
Yeah.
They could have gone wider, they could have gone higher, but they didn't. So the NIMBYistic mentality is still strong, certainly on the east side. However, that said, yes, is there opportunity there? I really think there is. In the areas which surround those nodes of mass transit. So you've got that going on. 1110, I said when it was first passed, was never going to be a panacea. It was never going to solve all our woes. It's always going to take some time. Forget the cost, but we know it's expensive to build anyway. But in markets where we've pretty much already built out, well, for a builder, he's looking at, okay, I've got to buy these 2 houses to tear them down. Now, the value for me is not the house. It's the land beneath it,
right,
but I'm paying for the house.
Yeah.
Again,
to get access to the land, you got to go through a house, and someone wants to get paid for that.
Exactly.
So the capital stack of House Bill 1110, admittedly, we were more ambitious in seeing more developments, and I still think some higher end micro housing projects are going to pencil still in the best neighborhoods, especially where you've got lifestyle, great school districts, close to light rail, and really the median home price is 3 times that of what the retail price is going to be for that micro housing project. So I'm thinking about, West Bellevue, Mercer Island, markets like that. But let's look at the other side of the coin, like on the luxury market. I mean, what's going on with the stock market? And these tech titans are just getting wealthier. And Is that going to help us out with waterfront and beautiful penthouses and custom home builds? What do you see for 2026?
I think so much of it. When you think about the luxury market, it's applicable with whether you're a tech titan or just a savvy investor. We're going to spend a bunch of money when we've made a bunch of money, but it's that predictability is remarkably important. And quite frankly, the richer people are, the tighter they are with their money. That's just invariably the way it is. So I think that a lot of people can be looking at what the equity market's going to do next year. And that drives a lot of their decision making. If we're feeling wealthier, then yes, we'll think about either upsizing or buying that weekend house or whatever it may be. But we've got to be feeling good about the world. Now, I think next year, I think it's actually going to be a good one. The reason why I say that is that we're going to be getting closer to midterm elections. I think some of the opacity we're seeing in the overall economy will start to become clearer. And when we start seeing that, we start making those smart decisions. I'm not saying it's going to be an amazing market as far as stocks go next year. We are in the middle of that euphoria that we've seen based upon AI, and that in essence only for one reason, that's capital expenditures. But you have these companies spending a whole bunch of money that raises all ships. But I think going forward, it's when we start getting some clarity on either some policies that are either going to make sense or tariffs that are going to go away. People want to get clarity, whether they're spending $5 million or $10 million, whether they're spending $1 million. They need to be in their own heads sure or have a certain amount of belief and happiness that I'm making a smart decision.
How well do you feel the Pacific Northwest and specifically our central Puget Sound region is competitively against the rest of the major markets in the US as I look at this perfect storm of FIFA global attention, beautiful summer, stocks are booming likely, AI is definitely playing a role here. I mean, all the tech titans are present here. Even NVIDIA is expanding satellite office space in the region for good reason. We've got very talented workforce, lifestyle, attainable commercial real estate market, and relative affordability compared to Santa Clara, various markets surrounding San Francisco. So, I mean, what is the intel telling you about the wealth generation and migration coming this way in terms of, California residents bailing out of the Golden State?
And they have been, certainly California, good example. Last 3 years, they've lost population.
Wow.
That's never happened in the state of California in its history. What we are seeing here is a couple of things. One, quite frankly, global warming. You can say it's a bad thing. But if you go back in time, historically speaking, our population in America migrated to the coasts, which is why coastal markets inherently always more expensive. You'll pay more to buy a home in Seattle than you're going to do in Ohio. Right? However, with that climate change we're seeing, as opposed to going to the coast, we're going from the south to the north. We are becoming, even if though it's raining today, the Riviera of the Northwest. So I think that is driving a lot of people to come further in our direction. That is a positive. Talent pool. We are remarkably smart here in the Puget Sound. The highest propensity for bachelor's degrees of any city in America. So we are wicked smart, as they would say back in on the East Coast. So those are the positives. But I will always, again, being an economist, caution the fact that, yes, it's great. The companies want to grow and be here. We've been very lucky, as you know, for a century, right?
Yeah.
It's Boeing or Microsoft or Amazon. But at one point, people saying, okay, you're smart, we want to expand or grow in your market. But the second thing they think about is, how much do I have to pay people? The biggest component of salaries is cost of living.
We're a very expensive labor market.
Right. So that's why I say is that, yes, we can look at the luxury market, and certainly it's very, very important, certainly to your company.
Sure.
But you still have to have that starting point. If you don't have those first-time buyers, then you don't have the move-up buyers. It's a chain of events that has to happen.
There are too many would-be buyers that are lingering in a lease and perpetually hitting the renew button or going to the next tower to populate and sort of leapfrogging because they're getting 12 weeks free rent and maybe no parking charge for 6 months or whatever the incentive is. And I do think that that's calming down because the new starts for rental housing are also very much being faced with these headwinds because they don't pencil as well as they might have, say, 6 years ago.
Oh, sure. And we overbuilt on apartments, and we all know that. So for a lot of concessions, but we're now seeing 2-3% rental rate growth. Starting to see some stability on occupancies. That's good. But I think there's one more thing, Dean, that's happening, which is really interesting. And that is that people who have to move for business, and you assume, therefore, they're going to sell their house because they've got to move. No, they're not. Where a lot of them, what they're doing is they're saying, okay, well, I'm sat on a 2% 20-year mortgage or a 3% 30. Well, why don't I move and I'll just rent this house out? I can actually cash flow it.
Yep.
And not, so therefore that's holding inventory back, point one, but also allows those would-be buyers that you mentioned of skipping between house to house to continue to do that.
Well, and the luxury leasing market is something that I'm also following very closely because you are incubating future inventory for a future market. And as you know, there's not any duress or distress in the mortgage underwriting for those properties. And so you've gotten executives that might be concerned about their position, or they might want to size down by leasing out their estate home into something more modest and kind of riding out this AI anxiety that I think is present, but then positioning potential sale in the future market. And to your point earlier, that if they don't have that make me move number show up in an offer from a broker today, they'll just rent it out. And that demand I see is pretty strong.
Yes.
So getting into luxury listings is part of our world right now.
Yeah, no, and that doesn't surprise me in the slightest. Again, I always tend to, I go with the theory that I ask you what's happening with your brokerages and are you seeing that impact? So you are very much the wall I bounce my theories off because you're the proof of it. So yeah, that is certainly happening. So I think as you go forward, we have got people moving here. There's no question about it. We need somewhere to live, obviously.
Right.
So the glass half full, I said 6 months ago that this year was going to be a better year for brokers than the year before. I believe I'm right. I believe that next year will be a better year for them than this year was.
Substantially better. I think most brokerages are pretty neutral year over year. There's been some gains with some other business models, but fundamentally the market was largely a repeat for 25 to 24. And I think we maybe have been incubating some greater climbs in 26 with these rate reductions, with sustainability in the stock market and, some other trends. And here's one of them that I'm also seeing, Matthew, that back to the idea that, hey, this home I'm sitting in that I could sell now or lovingly lease for a couple of years, why don't I look at downsizing into something else locally here and having a second home and do the hybrid work week, whether it's up in Suncadia or up in Bellingham or out in Kitsap County. I mean, there's going to be more and more of that kind of opportunity because we're seeing more exciting development take place for sale in those secondary markets that are becoming a primary focus. Because of lifestyle affordability, and also because so many of our executives locally are able to have hybrid work weeks. And so they want to have 1 foot on the beach and 1 foot in the snow.
Oh, there's no question about it. And also that generation, look at us, we're getting older. And so when we all suddenly start getting into the 50s, then it's like, yeah, okay, I've got the wherewithal. Said maybe that one single house is, don't really need it. Maybe the kids have now left and gone to college, wherever that may be. And it's always a good way to make sure they don't come back permanently, downsize. So, so those statements, those theories make a lot of sense. And so I think, next year, do I believe that the market is going to see more clarity? Yeah.
Let me ask you a question about investment and Seattle's competitive metro area, including Bellevue here. We have 15, 18 million square feet of unleased office space. And obviously that's tough sledding for those owners and for those lenders, but it is a bonanza for a new business to enter in. And that's a green shoot opportunity for venture capitalists to finance the next Microsoft or the next Amazon or the next NVIDIA. I mean, what do you see as the propensity for our region? Because we have the available office space and a better tax climate than some of our peer markets.
Oh, very much so. 15 minutes, is that all you've got? I mean, that's a luxury compared to downtown Seattle, where we're sitting right now about 35% vacant, and it's a far, far bigger market. I think a couple of things you need to look at there. Maybe something I got wrong. I thought that we'd see a lot more distress in that commercial market already, meaning, as we all know, that a commercial loan is financed differently to a mortgage. That I think a lot of people expected, as I did, those who've gone back to the bank already. Therefore, people that we've seen some not much repurposing, but coming back to market, very low prices. We found lenders kick the can down the road, and they did it for about a year longer than I had anticipated. That said, we all know there's a lot of distress. I think we'll see a lot of distressed assets be traded in 26 and in 27. And they're going to be traded at remarkably low valuations.
Those are commercial office buildings.
That is correct.
Right.
And so with that, well, that, as you said, that gives the opportunity to reset where lease rates will be. Then we're going to get away from the mid $50 a square foot mark, maybe down to the 30s. And it will still make sense to the buyer because they bought it at maybe a land price, who knows. And that, again, is going to be very compelling for startups. And as we all know, we've been a startup region since build Boeing in 1917.
Well, that's such a great point. And if we look at San Francisco as being a harbinger of what's to come for our region, AI, venture capital, and a return to the city is actually seeing a renaissance.
Yes.
And, it's helped too with some of their mayoral policies and cleaning up some of the unfortunate social and retail dynamics that were part of San Francisco. One of the most beautiful cities, just like Seattle, but had gone through a pretty bad bruising over this post-COVID reality. But hey, it's making a turnaround, and I see a lot of the same tea leaves up here in the Seattle metro area.
Yeah, and that's the case. Obviously, we have a new mayor coming in. I'm being asked a lot about that as to, have we got our own mini Memdani? I don't think so. And the reason why I say that is that the way the Constitution works is that the mayor only has a certain amount of power.
Right.
Council controls it. So we will see. As I was with Mayor Harrell, I'm thoughtful, I'm hopeful. I think that the worst is behind us. I think there's still a lot of work to do to address the social issues that do exist, as we all know, especially for urban dwellers, and I'm one of them.
Right.
That I love downtown. I love the dynamics. I've always lived downtown, other than for a brief period, and I want it to be what I remember. And I think that means that we've seen that out-migration because of COVID. I really believe that certainly the condo market has been oversold in downtown Seattle. And so they see an opportunity. I'm not saying that people can buy now and double their money in a year, but I think we've got to a point now, and as you know, nothing's going to get built.
There's less than 500 new construction condominiums left in existence in downtown Seattle, and that's a city of 110,000 permanent residents. So if you think about that, it's a pretty small percentage. If even a smaller percentage of folks decided to pivot from rent to buy on a unit basis, you'd be well out of inventory, and it could be 5 years before there's replacement homes.
At least 5 years. You know how long it takes to build.
Yes.
So yeah, I think I really see a significant amount of opportunity there. So I really think it has been oversold. We had that migration away, people not wanting to come back. And again, you live downtown because of proximity to work. As we see return to work happening, that's a positive. But also the social environment and the civic amenities is why people are there. As those start to really start to flourish again, and restaurants and what have you.
As cities regenerate and remake themselves, and someone will find opportunities in those storefronts and bring in other business. And I think with the millions of square feet of overhang for commercial office space, we'll eventually find tenants. They're just not going to be exciting lease rates for those owners or for those lenders, but they are going to be a catapult for business, which will drive household formation and more demand for housing downtown. So, speaking about this inflection point, maybe a renaissance that's upon us, we've got the global stage paying attention with FIFA coming here in the summertime. And there's this whole Cascadia kind of formation of attitudes, because Vancouver is part of that. Obviously, the Seattle area is part of FIFA. And, what do you think conditions will look like by the summer? We'll be a little bit closer to midterm elections. We'll have a rate cut or two, perhaps, from the Fed. We're going to have new Fed leadership. Can you speak to how you feel that might direct?
Well, let's start off with the footy first. In terms of football, soccer for
Yeah.
Americans. Yeah, it's exciting, sure. England's not playing here, unfortunately. I wish they were, but there we are. Australia is, but anyway. I think that it's going to bring a lot of people here. It's going to utilize pretty much every hotel room. And in fact, there's a big market right now, and people actually saying, I will lease my house out for a lot of money.
Right.
If I live relatively proximate to Lumen Field. It's got to be called Seattle Stadium, I believe. So, I think that's going to be a boon. I think it'll bring a lot of people here. That's going to be great for retail, really important. Great for restaurants, really important. Because they are still, it's a hard life for them. So I think it's going to bring a lot of attention to several cities, obviously in the States, where it's here, Los Angeles, Miami. So I'm excited for it.
Yeah.
I think a lot of people looked at Seattle and said, where? Oh, you're kind of Southwest Alaska is where they think we are. So I think it's going to help in that perspective. I'm excited to see where we are, but I think it's also going to demonstrate, have we got that infrastructure? Is our transit infrastructure as robust as we like to think?
And are we going to be on good behavior for the global stage?
I sincerely hope so.
Yeah, we have so much to be thankful for, and the natural beauty, and very long days in the summertime, and all the waterways, and hopefully, beautiful forecast, and, we're going to be looking the part. But I watched what happened in my hometown, Vancouver, after Expo 86, which ironically was the beginning of a really long run, because Vancouver was in the business of immigration, and obviously for the Pacific Rim was a very popular destination for investment. And boy, did that policy upzone with light rail, with sound transit, and of course the overlay of global exposure. It was just the perfect elixir for what became a vibrant series of decades. And it's only until policy got in the way of that again more recently that we started to see that correct. But I kind of look at the combination of our light rail here with Sound Transit 3, some upzone policy, the FIFA overlay for global attention, and just this overall economic climate as being the right ingredients for a more confident future for the second half of the 20s here versus the first half.
And I think you're absolutely right. You mentioned Vancouver. I think they got another Winter Olympics, haven't they? I think they were just announced that they are going to get one.
Oh, okay. I didn't hear that.
Yeah. So I think that, yes, it's anytime you look at any market in ours, which is, again, it's not a big area. Geographically speaking, population speaking, we're not Los Angeles size-wise, but I think that we have an amazing amount of positive attributes, and the more we can turn the global attention and the global magnifying glass on our region, that is going to help not just for the fact that people can say, well, yeah, Seattle's kind of cool and maybe it doesn't rain all the time, but more importantly, you look at business investment, look at migration, places people choose to be, and that is going to be a positive. So I am excited to see us for really, quite frankly, since the World's Fair.
Right. Since 62.
Exactly.
We've been waiting.
Yeah, Elvis was on the monorail. Yay. But really look at it and say, okay, well, now we really are front and center. I mean, there's going to be 1 billion people watching this.
Look at how far we've come.
Yes.
Well, as we look forward to 26, what are 3 game-changing trends that you think are going to be driving housing demand for the next year?
I think that it's just 3. I think that what I expect to see is we will continue to see new household formations. People have to live somewhere. And so I think the demand side of the equation is there. I think we're actually seeing more pent-up demand. So I think got a bit of a kind of a log jam, quite frankly. And the jam is the fact that people are there, but they're just not sure. That's holding them back. The inventory out there wasn't right for them. That's holding them back. And some, quite frankly, were saying, oh, I'm going to wait for next year because mortgage rate's going to be at 3% again.
I don't think so.
Well, it hasn't. So way we're going to break that log jam up is the fact that they are going to say, yeah, guess what? Maybe mortgage rates aren't going to drop down. Yes, though, I think next year they'll come down a little from where they are today, in my opinion. But if they're not going to, yet prices are either staying stable or going up, then why am I waiting? Why am I going to miss that house that I've always wanted to buy, that I've been watching for years, because it might not be there if I wait too long?
You can always refi, but you can't rebuy.
Exactly.
So
that's there. I think that I understand that, secondly, that there are some people saying the market's going to collapse. Oh no, I mean, after we saw that massive price growth coming out of COVID, well, isn't that 2008 all over again?
yeah.
No. So they're like, I'll wait because house prices are going to drop by 50% and I'll buy 3. Hasn't happened, won't happen.
Well, there's no duress in the
Right.
mortgages, right?
But there are people, again, that's another thing that's holding people back. So when you combine these things together, I think as we could actually see a release of demand, and if supply is there, and if the supply is priced appropriately, and maybe not because the homeowner says, I prune my rhododendron tree, it's worth 100 grand more than the guy next door,
Right.
then I can certainly see a market in 26 be more buoyant
Yep.
than it was in 25. And again, as I said earlier, 25 was better than 24, not the halcyon days of 2021 and 2022, but trending in the right direction. So as I've said for years, I've said to you, I've known you way too many years, people have written Seattle off and our region off a bunch of times over the last 50 years. Somehow or another, we always seem to survive.
But
And
what
we end
keeps you up
seeming
at
to
night,
thrive.
though? I mean, you're looking at some things you can't control. There's geopolitical concerns and outcome of these tariffs.
Oh boy, what keeps you up at night? A lot. So you mentioned the Federal Reserve. We'll see a new Fed chair come next May. That worries me because I think it's going to be somebody that's going to be more of a mouthpiece for the administration than independent, which is what the Fed has already been. But I'm relieved in the fact that the Fed governor does not control the world. There's a bunch of people who've got to vote on it. And so it's very hard for one person to say, you have to do this. And so that's the good part. I mean, have we seen it before? Yeah, we saw it in the Nixon administration. He had a Fed chair who he beat up, a guy called Burns. And yeah, don't do that because it was not a good thing because he wanted to get reelected. Anyway, that I think about. I'm not that worried about it, but if I worry about one immediately, it's going to be affordability. Because if we don't have that start, if we don't have that young household getting their foot on the first rung of the ladder, then we have a chain of events and a chain of transactions. So I'm looking at home ownership. They want to buy it, no doubt about it. The American dream is alive, but in my opinion, it's on life support. So I think we need to produce more product, which a first-time buyer could, one, want to afford, because that is going to help the entire market from the first-time buyer all the way to the luxury world. So we need to get them in, and we need to get them started on that home ownership road that we've benefited from. I have, you have, for a lot of years. So that is what worries me, because we live in a place that people want to be.
Right.
And they're going to continue to want to come here. But if they can't find somewhere to live, or if they're a company, they have to pay people so much money that they can't afford to open that company because they have to pay them a huge amount just to afford.
Cost of living is
Right.
becoming a headwind.
So those are two things. And finally, I'd say that, again, I don't talk politics, but I do policy. I look at the administration policies that are being made by Commerce, by Treasury. Let's see how some of those play out, because historically, we could get a good feel for what's happening. Now it's a case of decisions are made overnight. And I don't like that, because any global investor wants what? They want predictability.
Right.
And the final thing, we owe a lot of money. So $38 trillion right now is our national debt. You got to service it, and servicing that debt has an impact on mortgage rates.
Well, let's talk a little bit and finally about the job market and, AI wiping out employment. Is it going to be an apocalypse, or is it a thought partner that'll make us more productive? Which is an issue for consumer confidence? And what's the likelihood of a recession as a result of the job markets?
I think that, so macro-wise, recession in 2026, possible, yes. Probable, I'm not there yet. We did create numbers, some jobs in November, 60 odd thousand, that's good. October was horrible. So that's a negative part. Unemployment rate has started to notch higher. That's a concern, obviously. The positive about that is that as that happens, I think the Fed is going to be more considerative. They're going to concentrate more on the labor market than they are inflation, because that's part of their dual mandate. And if they do that, if they're looking more at the labor market, then I expect we could see a couple of additional rate cuts coming in next year. That could be a positive for the overall economy.
Right.
Again, not directly correlated to mortgage rates, but it does have some consequences.
Yeah.
So, yeah, I think that we've seen a lot of businesses, in essence, use AI as an excuse to trim down their workforce.
Right.
Not that those jobs that are being lost are being replaced, because they're not. But it's a great excuse to say that. But at the same time, I think that I'm, again, like any economist, on this hand, it could be great. This hand, it could be doom, gloom, and the apocalypse. I look at it and say that I believe that AI could be a great thing. I think people are saying and assuming that the impact's going to happen immediately. Year, 2 years, 3 years. I think it's going to take a lot longer for a couple of simple reasons. Our power grid is insufficient and we haven't built enough server farms, and that takes time. So I think that people are getting ahead and out over their skis a little bit in that respect. Will jobs get lost? Yeah, I think certainly some secondary industries will get hit hard. But I think a lot won't. At the same time, I see that a spawning of new industries that we don't even know yet. We don't know what they're going to be.
Yeah, what's the next innovation that's going to come from a smart city like the Seattle Bellevue metro area?
And so productivity goes up. That's great for the stock market. It's great for share prices. That's a good thing. So I think a lot of the doom and gloom that we've seen, and there are some reports that globally 300 million jobs were going to be lost due to AI. Well, the company that put that, was Morgan Stanley, put that note out. They've come back and said, yeah, maybe we were a bit too pessimistic. So a lot of people are, but it's very easy to say, oh, well, it's going to be horrible. It's going to decimate the world. No, it's not. I think there are positives there, but we need to be very cautious. And I think that certain businesses, and Google's a good example, Sergey Brin saying we need to slow walk this because this is a remarkably important thing that we're going to see as humanity.
Yeah.
So ultimately, yeah, we could see a recession. Yeah, I'd say right now, probably 45% likelihood today, but it's not 2008.
No.
And so if we do see it, and quite frankly, we're overdue.
Well, and it wasn't too long ago, Matthew, that we were hoping for a recession to start clobbering down some of these mortgage rates.
Yes.
I think the pent-up demand to be a homeowner is directly clipped by the current state of the mortgage rate. And with the anticipation that maybe a new Fed chairman trying to address a recessionary environment might be more apt to cut rates in 26.
Yeah, I mean, again, right now, Kevin Hatchett, he seems to be number one. Not a big fan, personally speaking, but I will still say the same thing, and that is that no one person can do it. And so I would like to see a Fed chair more like Volcker than Burns, but Volcker's one that kind of raised rates to get rid of inflation back in the 80s. He won't do that, but because the way the makeup of the voting members, which have permanent votes, that you also got the 9 central banks around the country, and they rotate it in their ability to vote. So I think that no one person can say, we've got to clobber interest rates down to zero again.
So in a summary to those would-be buyers that have been waiting
Yes.
for the marker to say, go ahead and buy, there's more reasons to lean in than there would be to pull back, because we're not going to get some dramatic rate cut that would make you, I mean, you could just refi anyways.
Yeah.
There's probably more likelihood that home prices are going to continue to rise. And so
Yes.
if you see something that's a good fit, there's more reason to make a move.
I mean, that's the thing, Dean, as we all know. I mean, housing historically goes up in value. It just does. We've had two systemic periods in history where they've gone down. One, 2008, we know what happened there. The other one was in the early 1990s. So it does. Now, does it go up 15% every year? No, and I hate it for the few times it's done that. That's never sustainable.
Right.
But it does. And I think for a lot of people, that home ownership has done a remarkable ability to generate and create wealth.
Sure. Another tax
Ownership
advantages, yeah.
ownership housing in America is worth about $53 trillion, give or take. And so we're sat on $37 trillion of equity. It's a lot of money.
Right.
And that's just in housing. So it is a smart thing. Again, it's shelter, it's home. It's where we raise our families. It's where we have I do now, grandchildren coming over. And it's tough to knock it, but to assume that it's going to make me a bunch of money tomorrow, don't do that. It's a home first investment, certainly, but that's a longer run. And don't bet against housing, because most of the time, other than once, quite frankly, you'll have lost.
Well, there's a lot that goes into supporting the housing market, and I am reminded that together we just sort of stir the mix in 26, and we'll find our way forward. It's a lot we've been through in these last 5 years, and I certainly feel much more optimistic in the second half of this decade for all those reasons that you've mentioned. And I do think FIFA is going to help sparkle these facets of our Emerald City, right? It's going to be a major attention gain for us. And we'll just continue our conversations with ongoing podcasts. And 6 months from now, we'll have another Futurecast Forum, and we'll always be looking forward to hearing from you. Matthew Gardner, thank you always.
Always a great pleasure, my friend.
This has been Market Perspectives. Please follow us online, and we'll see you next time.